Hello traders and welcome back to my YouTube channel IPDATrader. Now in today's video I will be going in depth into institutional order flow. We will be talking about that. We will be explaining some stuff regarding order flow, how to spot it on the charts, what it actually means, and how we can use that information in our advantage. However, before we proceed with the video, I would like to take a second to thank every one of you for the support that I have been receiving on the channel lately. Wanted to let you know that I appreciate that. And my sole intention with this channel has always been to provide as much value and information about the markets to the average YouTube viewer. So far seems like things are working out and I'm pretty happy about that. Lastly, I also just recently opened a free Telegram channel where everyone is free to join. I won't be super active over there because I'm still managing my private group and that's my top priority at this point. But feel free to join the channel, send analysis, ask questions. I will do that as well, right? I will be sending analysis from time to time. Just don't expect too much information because I still need to focus on my private channel. So yeah, everyone is free and everyone is free to join. If you want to do that, you can go ahead and click the first link in the description and you will be taken to the channel. Now, with that out of the way, let's actually get started with institutional order flow. Okay, traders, we're back on the drawing board as we usually do, and we're going to get started with today's topic of discussion. So as we said before, we're going to be discussing institutional order flow. Now, what you may be asking yourself at this point is, what is institutional order flow? And to give a quick and brief definition so that each and every single one of you can easily understand it, institutional order flow is the act of smart money and big banks of constantly introducing buy and sell orders to the market, right? What you need to understand is that the people that are moving a particular price, they are constantly buying and selling the market, right? They're not just buying it or not just selling it, right? They're selling it at this point, they're selling it over here, they're selling it over here, here and here, and so on and so forth. You get the idea. And they're buying at those points as well, right? They're constantly introducing buy orders and sell orders. Now, when a particular market, just like in this case, is pushing up, what you can deduct is that whenever they're introducing buy orders, those buy orders have bigger volume, and for that reason, the price is pushing up, right? Now, the reason why price is pushing up, that may vary across different scenarios, right? You may have a equal high liquidity sitting over here, and that's the reason why price may be pushing up to target that and take that out. Or you may have trend line liquidity all across here and there's multiple stop losses, and for that reason institutions are introducing more buy orders, right, to take that out. Now, another thing that I want you to understand is that there is no human interaction whatsoever, right? You and me, even if you think that you're throwing in 100 lot on gold, right, that is not going to be affecting price at all, right? You cannot expect just because you threw in 100 lot buy on gold that now price is going to go up, right? That has no impact or influence at all on what price may actually do. Everything is actually pre-programmed and predetermined by an algorithm, right? From the first candle of the day to the last candle of the day, everything was pre-programmed and predetermined by the algorithm. Another thing that you need to understand is that there is no human interaction whatsoever, right? There's no human sitting at a big bank. Let's, for example, imagine we're looking at a currency such as GBP USD, right? Now, you may be asking yourself, who controls this market? Well, it's pretty obvious that the people who are moving the market in this case are going to be the ones that own the currency, right? In this case, the main currency here is GBP. So the Central Bank of England is the one that is deciding where GBP USD may be heading in a particular day or what may happen with the currency, right? The Central Bank of England is the owner of the currency and has the power to actually decide what's going to happen, right? So what I want you to understand is that there is no human actually deciding, well, we're going to be buying GBP USD today or selling it today, right? Everything is actually pre-planned and pre-programmed for them, right? They just be maybe following certain instructions or guidelines. However, they do not decide what price is going to do. Everything is actually determined for them. So yeah, that's that in regards to what institutional order flow is. I hope that was pretty useful for you guys. Let's actually continue discussing further ideas. So the concept that I want to introduce to you guys today is something that I've not seen publicly on YouTube before, and I want you guys to appreciate the fact that I'm sharing this information with you guys for free. So the concept that we're going to be discussing now that is going to help you with understanding institutional order flow and actually tracking where institutional order flow is sitting is called LPOTM, which stands for last point of true mitigation, right? If you want, you can write this down. This is a concept, right, that is going to help you a lot in tracking institutional order flow and actually seeing where the interest is sitting. So let's actually get started with that. And for that, let me remove all this and let's now draw a potential bearish trend, right? So this is a bearish trend. We can all agree that price is pushing down. And what is the last point of true mitigation? Well, it's pretty simple to understand, right? Each and every single time you have a break in market structure, your eyes should be instantly magnetized to the origin of that break, right? Which is in this case is this. And if we look closely, we can see that this up move actually mitigated this previous structure right here, right? So now we can actually deduct and understand that the interest in this market is sitting right here, right? This is where they last actually introduced a majority of sell orders, and this is where the interest is protecting price, right? So now we can go ahead and label this, and I would suggest you guys do this whenever you're trying to track order flow in your actual candle charts, right? So this would be considered your last point of true mitigation, right? And this information is going to help me a lot in tracking order flow, right? Because now I know that all these POIs over here, right? This potential those potential order blocks all across here, they have no relevance, right? They can get easily taken out, right? Into the last point of true mitigation. As long as we're holding this point right here, we're still bearish and the interest and your bias should still be bearish, right? So what you can expect is that price can return to that last point of true mitigation, and once we get there, price may actually continue and resume the overall interest, which in this case we can see that is clearly down, right? Let me actually save some space to keep illustrating that. So now you would update your last point of true mitigation, and now you can understand that, hey, this is where we lastly mitigated, right? We broke structure over here. We mitigated this previous, let me actually mark it. We mitigated this previous block, and now we've actually returned over there, right? We can see it here. We've returned here. This is now the moment we get the break in market structure again, you can assume that this structure right here is where institutional order flow is holding, right? So you can go ahead and update this. This is your last point of true mitigation. And you can keep doing that back and forth, right? As long as you don't break that structure point, you're still valid for sells and you can still expect sells. Now, the moment that gets breached, then is where you can have a potential shift, right? If you then break that point, you can now safely say that, hey, the institutions have no longer interest in selling the market. Why? Because if they did had interest in selling the market, they would have protected this high, because this is where they last mitigated, right? If you see the line across here, it connects one structure point with the next one. So if they wanted to keep making money selling, they would have protected this point, right? And they would have actually continued lower right there instead of pushing up. But since they broke structure to the upside, you can now assume that the overall interest of this market has shifted from bearish to bullish. Now, I know you now may be asking yourself, Well, following the principle you just explained, right? This is a break in market structure right here, right? This low getting broken over here, and this is a return into the potential origin of this fractal structure over here, right? Then how can I filter those points of mitigations that actually have no relevance and are not going to hold? And the answer for that is actually looking at structure, right? Structure will always give you the keys and will always tell you where we're potentially heading, right? If you would have paid attention to structure, your structure could now look something like this, right? You may have the origin over there, you have the low over here, you had the mitigation over here, you made a new low, and you're potentially now shifting bullish, right? And if you look at this particular price point, what you can identify is that this is just internal structure, right? This has no relevance at all on what the overall higher and external structure is actually doing or playing. And again, if this sounds confusing, you can always revisit my video on structure, because I go very in depth on that concept over there, and that's going to give you a lot of valuable information. So yeah, that's that in regards to the concept of the last point of true mitigation, right? It's a pretty important concept. It can help you a lot in tracking the institutional order flow, but you should not use this alone to take and frame trade ideas, right? You need to have the confluence of you need to have a confluence of structure, liquidity, POI, confirmations, and that sort of stuff. Yeah, it's a puzzle that you need to piece together in order to make everything work. I'm just now giving you an extra tool that you can use to track order flow in this case. So what I suggest everyone do, and this is something that I regularly do with my private group, and that's something that's going to help you a lot in tracking order flow, is let's delete all this stuff, is potentially go to a very volatile pair such as gold and watch the 1 minute time frame, right? And you will actually see how those points of mitigations actually hold, right? Following the principle, let's do it like this. Let me actually do it better, right? So we have a structure that can potentially look like this, right? We can draw it like that, potentially higher. Okay, so now you say to yourself, this is a break, this is my origin, and the moment we mitigate here, right, and break structure higher, this is considered your last point of true mitigation, right? And you can keep tracking order flow back and forth inside the 1 minute time frame. And yeah, you're going to be doing that, right? The moment this point of mitigation breaks structure up, you can now expect that the institutions are holding price right there and that there is no interest of going lower than that, right? And for that reason, as you can see, price returns here, mitigates the last point of true mitigation, and now this becomes your last point of true mitigation, right? And if you look at a very volatile pair such as gold, you're going to be seeing that happening back and forth, right? And that's going to help you in tracking order flow, right? However, one advice and something I will tell you is that you want to be using higher time frames, right? You want to be using the higher time frames for this type of concept, if I'm being totally honest. And the reason being is because higher time frame actually it takes more time to develop a candle, and for that reason, that particular candle has more orders inside of that candle, and that means that there is a higher probability that that is going to hold, right? Rather than a 5 minute last point of true mitigation, right? You will always want to be using higher time frames, because even though the market is fractal and essentially everything occurs in every single time frame, right, back and forth, you want to be using the higher time frame ones because those have more orders and in essence more information and hold more weight, right? So yeah, that's that in regards to the technical explanation. And now we're going to be moving back to the charts so that I can illustrate the points even further, right? And actually translate all this information into candles so that you can have an idea of what it actually looks like when you're trying to track institutional order flow. Okay, traders, we're now looking at the charts. This is gold on the 5 minute time frame. and we're going to be trying to translate the ideas and information that I just gave you before to the candles, right? As we usually do within this video. So let's actually get started. And as I said before, this is a 5-minute time frame, guys. This means that each and every single candle duration is 5 minutes. So the information and the amount of orders that these candles have is not going to be as precise and as valuable as a 4-hour or 8-hour or daily time frame. That's something that you need to understand. And what you will see happen within this price action is that you're going to be seeing price shifting from bullish to bearish back and forth, right? Without much explanation. But that's why I said that is a good practice to look at the lower time frames, because you're going to be seeing order flow shifting back and forth within this time frame, and that's going to lead you into a better understanding of the concept. So let's actually get started. We're looking at gold, and we're going to be trying to find an example that can be suitable. This is actually good right here. So ignore all this previous noise. Let's start right here, right? So you have a low right here. You have a high. We have a break. So this is now your impulse, right? Now, following the concepts that I've been teaching on this channel, you would wait for the origin to hit. This is exactly what happens at this point, right? So now, with the understanding that we have now, we can now safely say that, hey, this entire block right here, and you can use this line on the top and this one on the bottom, right? If we actually get the tool, this entire region right here is your last point of true mitigation, right? And as I explained before, this is the last point of true mitigation because this is the last mitigation that actually came to the origin and led to a break in market structure right here at the top, right? So now we can safely say that, hey, this is where we last mitigated, right? And what I actually like to do is grab this tool, connect it over here, and name it. This is now your last point of true mitigation, right? This point right here is where order flow is sitting, right? We can safely say that the interest in this market is to protect this low and continue making money up. If we're just taking into consideration the 5-minute time frame, right? Without looking at the overall picture, which is essentially something that you should do and what I suggest you actually do. So now if we drag this across, let's actually see if this holds, right? The theory tells us that now this is going to hold if they want to keep making money selling. So let's drag it across and let's see if we ever return inside this region, right? From the top to the bottom, right? This is our region where the last point of true mitigation occurred, and this is where we could be expecting potential up moves away, right? So if we drag it across and we zoom it here, we can actually see, even on the 5-minute, how price returns inside this region and continues higher, right? We can safely say that, hey, this was the last point of true mitigation, so we drag it across, and now that we've mitigated again, we can update this, right? As I said, as I was telling you before, this was our previous last point of true mitigation, right? We can maybe put it back over here, and now we can say that this entire block right here from the wicks high, whoops, to the wicks low is your new last point of true mitigation, right? This region right here from the top to the bottom. This is now your new last point of true mitigation, and you can go ahead and name that last point of true mitigation. And yeah, this is pretty much the theory. Let's actually see if this ever holds or not. So if we drag it across, we can see that we tap into it right here. We move away for a bit, right? We potentially shift, but then we resume bearish. And the reason being is because this, once again, this is, oh, whoops, this right here, right? If we look over here, is the 5-minute time frame, and this is not good enough of a information for you to frame trade ideas on, especially only looking at last points of true mitigation. As I said, it's just a tool for you to track order flow, right? So we can clearly see this this actually fails, right? And we continue lower, and that's fine. That's going to happen, especially if you're only looking at one time frame. So let's do one last example over here. We can say this is a low, this is a high. We break this internal structure, and now we have this order block, right? And as we can see, this is our last point of true mitigation, this entire region right here. So let's remove this quickly. Let's remove this, and let's actually go ahead and draw it out. Now we understand that this price action mitigated the block, so this becomes now our last point of true mitigation. And as we can see, price actually returns here and continues higher. So yeah, even on a 5-minute, this can actually work sometimes, but you need to be taken into consideration all these other factors that I've been telling you all the time, right? Structure, liquidity, POI, confirmation, time is also pretty important. So yeah, that is it for this video, guys. I hope you guys found this video useful. I hope you learned something today in regards to the algorithm or order flow. And until next video, I wish you profitable trading. As I said, remember the Telegram link to the new group is going to be in the description. So feel free to check that out, engage with me, join the group. I will try to be as active as possible, right? So until next time, I wish you profitable and good trading.